Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Today I want to talk about something that sits right at the center of the pre-seed opportunity, because for many investors, the natural reaction to buying into an asset management platform at an early stage is straightforward. They think this all sounds good, but it really comes down to one thing. Will the fund actually raise? And that is exactly the right question, because a pre-seed investment into Rise Capital Asset Management only becomes truly compelling if there is a credible, staged and institutional pathway to raising the capital that sits behind the broader platform. So today I want to explain why, once you understand the limited partner strategy behind the fund, the pre-seed starts to look very different, not as a speculative early stage bet, but as an early entry point into a platform that has been designed to become viable before it ever reaches full scale. And that distinction matters enormously. The first point to understand is this: the strategy is not built around raising the full £50 million on day one. That is not the model. The fund is intended to be raised on a staged basis, with a first close target of £10 to £15 million, followed by later closes as capital is deployed and performance is demonstrated. Even more importantly, the document makes clear that the fund and platform are designed to be viable from first close. That means a governance framework, economics, reporting and operating model do not depend on having all £50 million committed immediately. This is one of the most important differences between a credible platform and a fragile one. Fragile businesses depend on one big event going perfectly. Strong platforms are built so they work in phases. They work at first close. They work as capital scales, and they improve as execution gets demonstrated. That removes the single biggest fear many investors have in early stage fund platforms: binary fundraising risk. Rise Capital addresses that directly. Fundraising in private markets is typically phased, especially for first-time or emerging managers, with a distinction between first close and final close. Rise Capital is structuring the fund so projects can be acquired on a rolling basis. Management fees are earned from committed capital from first close, and reporting, governance and distributions operate fully from launch. In other words, momentum is intended to come from execution, not from hoping one giant fundraising event happens all at once. That point alone should change how serious investors think about the pre-seed, because the real question is no longer, can they somehow jump from £0 to £50 million overnight? The real question becomes, can they secure a credible first close and then scale through institutional execution? That is a much more realistic, much more investable proposition. Now let's go to the next issue. How does the first close actually happen? Again, this is where the strategy becomes compelling. Rise Capital does not rely on one source of capital. It uses multiple LP channels. The first is a regulated private capital marketplace intended to connect Rise with a global network of pre-screened, mandate-aligned allocators. The stated benefits are access to relevant LPs, data-driven allocator matching, and institutional visibility from day one. That matters because it means LP sourcing is not based on cold outreach, vague networking, or speculative hope. It is tied to institutional infrastructure, and that is exactly what sophisticated pre-seed investors want to see. They want to know that the route to LP capital is being handled systematically, not casually, not optimistically, systematically. But that is only one part of the strategy. Rise Capital also has additional cornerstone LP channels, sponsor-aligned HNWs, and family offices with experience in real assets and private markets, SSAS, and pension-backed capital suited to long-term income strategies, and smaller institutional or family office investors who may start smaller and increase commitments over time as reporting, performance, and distributions are demonstrated. This is exactly how risk should be managed, not by relying on one investor, not by relying on one platform, not by assuming one capital source will solve everything, but by creating several aligned channels and building the first close from multiple sources of demand. That means that LP strategy mirrors the philosophy of the platform itself: diversification, structure, repeatability, and avoidance of single point failure. That is why the pre-seed becomes much more compelling once you understand Rise Capital's LP strategy, because it shows that what is being built here is not just a fund, it is a capital formation system. And capital formation systems are what create durable asset managers. Let's go one level deeper. Why does this matter so much to the pre-seed investor specifically? Because the pre-seed is not simply backing a concept. It is backing the company that sits above the fund structure. That means the value of the pre-seed investment depends not only on the economics of one fund, but on the platform's ability to become a real manager with real capital under management. The LP strategy matters because it is the bridge between a promising platform and a functioning asset manager. The stronger that bridge is, the stronger the pre-seed case becomes. Rise Capital's LP strategy strengthens it significantly. It also helps that its scaling plan post-launch is not vague. Rise Capital's strategy is that after first close and initial deployment, the fund is intended to scale through later closes, driven by visible deployment, independent reporting and NAV calculations, early cash distributions, and repeat commitments from existing LPs. We envisage that broader allocator platforms and capital advisory networks will be engaged later, but as a scaling tool, not as the starting point. That is exactly the right sequence. Too many early managers try to look institutional before they have operating proof. This plan does the opposite. It starts with aligned first close capital, proves deployment, proves governance, proves reporting, proves distributions, and then uses that evidence to broaden institutional reach. That is how durable managers get built, not by pretending to be bigger than they are, but by becoming more credible with every stage of execution. And from a pre-seed investor's perspective, that is very attractive. Because if the model works from first close, and if further closes are supported by real operating evidence, then the company you are investing in at pre-seed is not waiting passively for success. It is compounding toward it. Now let's talk about risk, because this is where many investors either lean in or walk away. How does Rise Capital address LP sourcing risk? Sourcing risk is mitigated through diversification across multiple LP channels, avoidance of reliance on any single capital source, and a fund structure that is viable from first close. Rise uses independent fund administration, governance oversight, and transparent reporting as confidence building mechanisms. That is exactly the sort of language serious investors want to see, not because it guarantees success, but because it shows that the right risks are being identified and managed correctly. And that is often the difference between something that sounds exciting and something that actually becomes investable. There is one more important dimension here: optionality. Rise Capital is thinking ahead, as investor interests in the fund are intended to be tokenized to improve transferability and provide optional secondary liquidity. Tokenization means the investor, limited partnership agreements in the fund become tokenized, allowing fund investors to trade their investment in the fund on secondary crypto trading platforms. The direction of travel is clear: greater flexibility over time. That matters because it shows the platform is not only thinking about capital formation today, it is thinking about the investor experience tomorrow. And platforms that think that way usually have a much higher ceiling. So when I step back and ask myself why this should convert a thoughtful listener into a pre-seed investor, the answer is actually very simple, because the biggest objection has been addressed. The objection was never, is the market opportunity real? The market opportunity is obvious. The objection was, can this platform actually raise and scale the fund? And Rise's strategy shows that the answer is not based on hope. It is based on a staged, institutionally credible LP strategy, a viable first close of £5 to £10 million, a platform that works from first close. multiple LP sourcing channels, institutional visibility, post-launch scaling through evidence, reporting, and repeat LP commitments, and a diversified approach that avoids dependence on any single capital source. Once you understand that, the pre-seed becomes much easier to see for what it really is. It is not just buying into an early company, it is buying into the manager before the first close proves the model to the rest of the market. And that is usually where the best platform upside exists, because by the time the first close is complete, capital is deployed, reporting is live, and repeat LP commitments begin to build. The market no longer sees an idea, it sees a manager, and managers are valued very differently from ideas. So for the right investor, this is the key point. You are not being asked to believe in a business that only works if everything happens perfectly at once. You are being offered access to a platform built to work in stages, built to operate from first close, and built to scale through execution rather than hope. That is why this matters. And that is why, once you understand the LP strategy properly, the pre-seed starts to look far more compelling than it does at first glance. Thanks for listening. And remember, the most attractive early stage investments are not the ones with the biggest story. They are the ones where the path from idea to execution is already visible. I'll see you in the next episode.